Ready, and there was a bit of an connection issue there. Rahul, good morning. Thank you for joining us. Rahul, if I look at the market purely from the prism of what has happened to the Indian market breadth in last 4 5 days, it is been very brutal. But index is sitting at an all-time high. It's rare. It's rare that you see a carnage in the broader market and indices are at an all-time high. Why are we looking at such kind of a divergence?
Okay. So for that, Nikunj, we've got to rewind and see what's happened in the market over last, I would say, 12 to 18 months. We've had some of these mid caps. Look at real estate name, look at metals, other mid small caps, which have gone up 3 4x from the lows. And I think all these moves have been all the more pronounced in last 3 4 months. I mean, everybody in the market was kind of worried by how some of these small caps with not so great fundamentals had performed over last 3 4 months. So I think there was fair bit of an excess. There was a fair bit of what you were saying initially, a fear of missing out. That is getting cleansed out, and I think the reason for the cleansing is again what we saw over last 1 week, the strong payroll number from US, and this thing of US doing tapering, which means liquidity gets reduced, and it was a rising tide which lifted all boats over next last 12 18 months. I think markets are going to be far more discerning, so we are going into the second phase of the market where you'll see be derating for the markets. Companies which are able to show earnings growth will give you a net positive returns.
Rahul, in general, Indian markets have done very well, and we are the second best performing market this year after Saudi Arabia, which is an irrelevant market because of Aramco. Is there a temptation that after the recent run up, despite the underlying bent of the economy, one is better off not one is better off taking some chips off the table, and it is better to sit on some India cash rather than remain fully invested?
It may not be a bad idea to just be on sidelines for next 3 to 4 months. One has to see how globally things kind of play out, and that is in terms of rise of bond yields. That's in terms of what happens in terms of flows to various sectors, most of the sectors which have done well. So I would agree with you that look, there is no need to hurry to buy into this market. One can be on a wait and watch mode for next 3 to 4 months. You will get good entry points. You will get good entry points from a medium term perspective for investors who've got a 12 to 18 months perspective. I think markets are going to be higher from where we are. There is a bit of an uncertainty on how it plays over next 3 to 4 months.
Any concerns, Rahul? Firstly, hi, morning. This is Mubina joining in too. Any concerns, Rahul, with respect to the valuations? Because there is a pocket of the market that is pointing towards that as well. Do you have any concerns about that? Or perhaps certain mid and small caps where you think the valuations have run up way ahead of what they deserve?
Yeah, so again, I think a simple way is look at the valuations of these companies for 10, 15 years and see where they are today, and more so for the mid and small caps, where they are compared to their historical valuations. So there is a lot of a thematic story, bullishness, which is there in the market. I think that gets corrected in coming quarters as the earnings fail to live up to the hype. Already, what we've seen in this quarter earnings is the gross margin pressure. That's been somewhat mitigated by the savings on SG&A. I think the gross margin pressure continues to remain, but I'm not sure whether companies can cut back on as much SG&A as they have with the economy opening up. So you'll see margin pressure coming through. There are parts of the market where companies are upping up the capex, so obviously that is going to come through in higher interest burdens, etc. So I think the frothiness will get corrected over next 3 to 4 months.
Exactly. So we are seeing gross margin pressure. There could perhaps be a reversal in the financing costs as well. We could be seeing an interest rate hike, maybe not now, but a few months down the line. So the question is then, as the EPS sort of then becomes a little more sober and somber, which pockets do you see the most correction kick in, so that the valuations sort of start to make sense then?
Okay, I would just answer this question in a different way. I'll say the pockets of attractiveness today would continue to be banks. Look, these financials have not really participated in the rally. Insurance have, but the banks haven't participated in the rally. So some bit of an inflation is good for them. They will see pickup in credit. I think the incidence on credit costs because of the second wave is not as bad as we feared. So clearly that should be a space one can go to, and that would do well even if the market corrects. Names which can correct is basically some of the consumer discretionary names where there's still a bit of an optimism built in. People are hoping for a strong recovery, giving them all the benefit of doubt on margins also. I think that's where we can see multiple derating happens and earnings growth not commensurate enough for the multiple derating. So that's pocket. Small cap, mid caps, like the way we said, the half time is over. That half time of easy liquidity is over. We'll see money now going back into the economy rather than markets. So that's where some of these small mid caps may see multiple derating.
Rahul, want to talk about what's happening within the metals sector. Considering just yesterday you had the US Senate pass a massive infrastructure bill. The bill now heads to the US House of Representatives. The Senate voted to approve a $1 trillion infrastructure bill, which is now likely to provide the country's biggest investment in roads, bridges, airports, waterways, etc. And the kind of multiplier effect it's going to have. I mean, just day before, you had the metals, Dow Jones US Iron and Steel Index notch up almost 7.5% gain. Yesterday again, it was up 4.5%. And what it really spells for global stocks at large. Are we looking at a super cycle in place?
Okay. So from a 3-year perspective, we would be very positive on metals. Look, apart from what you said, which is the US infra spends, and those infra spends would come in about 6-9 months from now. Look, as these projects get finalized, they start commercializing the projects. There is going to be a time lag between when the budget, when the bill is passed, and when the actual spends happen. So I think there is a 6 to 9 months timeline for that. China is looking to cut steel, aluminum capacities to control their carbon footprint. And I think a lot of this happens ahead of Beijing Olympics next year. I think the uncertainty for metals is next 2-3 months. What's happened is a lot of this easy liquidity because of the reflationary trade has gone to commodities. And I think as this liquidity moves out, one may see metal price correction. And these stocks also have been strong performers. Like we've been bullish on some of these metal names, and they've been nearly 3-4 baggers in last 9 months. So I think near term, this is a sector which is vulnerable to some profit taking. Would be more positive on the sector post a 20% correction. But this sector can easily correct 10 to 20% over the next 3-6 months.
Interesting. I also wanted to understand what is it that you're making about the ongoings in the pharma pack, considering, the US generic pricing really seems to be coming under the clampdown and under pressure. We've heard that in the commentary from a Lupin, from a Cadila, as well as Sun Pharma too.
So I think pharma is a tough sector to make money, and why I say that is, look, the overall headwinds are intense in terms of pricing pressure coming through in US. So it's more of specifically focusing on companies who've got a good specialty business in US and where you've got meaningful stock specific, a new approval or a specific molecule ramping up triggers. But just to buy a basket because of the generic story, I think that's behind us. In that space, we like hospitals. So that's something we've liked for a while. Some of the hospitals like Apollo have done well on the telemedicine story, but outside that, there are a number of other plays, Narayana, Fortis, which still look attractive. And look, as the economy opens up, people go to get their much needed, much awaited surgeries done. So there is a elasticity which plays out over there. So I think hospitals are very attractive, and even this uncertainty, even this period of inflation, they'll continue to hold on well.
Would you be okay with taking disproportionate bets? When I say disproportionate bets, larger than usual in the consumer tech space, which is now getting created in India? It has started with Zomato, and soon you'll see 3-4 more large, big consumer tech companies which will go public.
Okay. So we've been looking at this space, Nikunj, very closely, and again, invested in the likes of Meituan in China, have seen and tracked this space for the last 3-4 years. So clearly, again, these valuations are much expensive than one we thought. One likes the space. There's a huge TAM. The managements are good. The stocks are going to be very volatile over the next 1 or 2 years as the managements establish their credibility on execution, etc. But like the way I said, these are high growth space. There is a part of the portfolio which could be devoted to this. And I think that's where some of the existing consumer discretionary or staples name would suffer, because they would act as the funding source for the emerging tech consumer space, basically.
5 years out, Rahul, let's look at the big picture here. 10%, 15%, nobody knows. Do you think a basket of HUL, Marico and Hindustan Liver will make money, or it could be a basket of Zomato, Nykaa and Policy Bazaar which will make more money? Because they both are a play on consumers.
Yeah, so I think if you look at the market caps and if you look at the execution, some of these emerging tech companies are doing, I would bet my money on these some of the emerging tech companies. So, like the way you rightly said, 1 or 2 year, one doesn't know. But look, if you take a 5 year and you look at the skill sets they have and how quickly are they moving, the innovation they're doing, I would put a bit more money on these emerging companies over the established players. I think the established players would do well. They would compound at a slower pace, probably whatever 12 to 13%. Some of their multiple derating would happen. These emerging consumption tech companies would compound much faster, and that's where the wealth you will create would be a lot more in the new basket.
Where do you think the
We seem to have snapped that line with Nikunj. Just taking stock of what the market is up to. We're lying absolutely flat right now in trade. The only good thing is that the market breadth has recovered. About 100 stocks are holding up right now. 62 the decline, and that's much of a relief considering what was playing out in the small and mid cap index month to date. That basic clarification surely helped raise sentiment a bit after yesterday's rebound. Today you're seeing some meaningful moves coming in. Rahul, where is it that you would be wary in the market right now? You did highlight your views on the broader universe, that's the small and mid-cap spaces, but any sectors which are looking overheated to you at this juncture?
I think metals clearly stand out as something which is a bit overheated. Real estate has done well, so can be vulnerable to pull back, though I must say that we're very bullish that sector from a 2-3 year perspective. Outside that, I think market's broadly okay. So these consumer discretionary names, a bit expensive, they can correct by 10-15%, but then again they become attractive. So I think markets broadly okay. But what would happen is within sectors, if you see, there would be sectors like financials which may be up 5 to 7% over the next 6 months. There would be other sectors would be down 10 to 15%. So there is a swing of 20% within sectors which we see over the next 6 months.
Interesting. Aside of metals, what's also happening is a strong, big rally taking place in agri commodities, Rahul. We've seen how some of the sugar plays, for instance, the Indian government's focus on ethanol blending, for instance, has augured very well for the entire sugar companies, for Praj Industries, etc. as well. Anywhere within the agri commodity universe you find comfort?
Okay. Honestly, we've not done much work over there, so won't be able to comment on these smaller names. What we continue to like is some of the tractor plays, just coming from the same kind of a thought process that look, agri commodities are going to be buoyant, and with the buoyant agri commodities, the whole ecosystem does well, which is the semi-urban rural economy ecosystem. With governments, with what's government done on infrastructure and the rural spends, that's positive. So I think that's where these companies benefit.
Extension to what you were talking about earlier with Nikunj on Zomato, just wanted to understand how large is the interest from an FII perspective when it comes to the new age internet plays, because it's not just Zomato, but there are many in the offing. You've got Nykaa, you've got Paytm, you've got Policy Bazaar next.
So I think there's a fair bit of an interest. So if we see across EMs, there are just handful of names ex-China where FIs can invest in, and China with this regulatory oversight which is happening, I don't think you will see incremental allocations over there over next 6 months. So then that leaves ASEAN and India. ASEAN, they're just one or two names, listed C, etc. platforms. I think India is where there is a lot of focus from a FI perspective. And what happened is over last 2 years of COVID, these companies have gained significant critical mass. So if you look at their revenues, the revenues are up nearly 3 to 4 times over last 3 years. These are good managements, adoption is high, the headroom for growth is high. So they're speaking the right language. And hopefully, if it's followed by execution, then they can generate significant wealth for investors.
All right, understood. So we've spoken a lot about the consumption-oriented names, and I think realty as well does come into this pocket for a lot of reasons. Given the fact that we are expecting more and more individuals to go ahead and purchase a house for themselves. We've seen realty sales as well pick up. I want to move away from the realty names, or rather the consumption-oriented names, and go more to the B2B names. Rahul, we were just talking about a stock like a Siemens, massively overvalued, but again, that's an exception. But the one thing that's not an exception is the kind of commentary they've given. And that is that they have reached pre-COVID levels when it comes to their order book. This is a very encouraging sign. It's a very optimistic sign. Do you think that we could see potential for the cap goods sector? Because this has been a space which has been very slow in terms of its performance.
So absolutely, you're right. And this is something we've been watching very closely. There are big debates in the team on this, but look, if you get the investment cycle going, the growth or this whole India story gets a good escape velocity. In the past, what's happened is what we saw over the last 10, 12 years was government giving handouts that led the consumption growth, but obviously the wage growth was limited. And I think with the strong investment cycle, that creates job that has higher wages, and which is a virtuous cycle, eventually benefiting consumption. So this is something we are exceptionally positive on. I mean, we've got exposure to a number of companies and would be looking to increase exposure to this space despite high valuations, because we believe we are just in year one of the cycles. So if you look at the capex intents, those intents have picked up significantly over the last 6 months. You've got obviously the metal companies which want to invest. You've got the likes of Reliance which wants to do investments in your batteries, solar, etc. You've got the chemical companies who are looking to invest. So I think as this gets kind of a more pronounced with this and the data center investments, that's very positive for the economy. So from a global perspective, if you see capex in India, more importantly the capex in US which is picking up, is a big positive for this recovery to be a multi-year recovery basically.
Okay. Since you brought about the topic of new energy that a lot of these companies are investing in, what's the best way to play that? And when you say new energy, also it's not just solar, wind, and power. We have hydrogen cells, and we have so many other new concepts evolving thanks to the great inventions that our scientists have been bringing about. What's the best way, according to you, to play this theme?
See, in India, we don't have any clean plays, but outside India and the regional funds which we have, we are playing some of these leading battery names in Korea. We are playing it through the solar names, the solar chains, some of the companies which supply material like lithium, etc. in China. So there are good plays outside India. The hope is in the next 2 years, as Reliance shows something on execution, we can get a good play within India also. But at this point of time, one would be wary of going into these solar companies. They're not, honestly speaking, they're not much in India. For whatever you have, it's still biased towards the conventional fossil fuels, etc.
Indeed. The other thing, of course, Rahul, the big disruption which is bound to happen here in India as well, the EV disruption. Just wanted to understand, because you lightly did touch upon that, as to what it really means for autos, and especially in the backdrop of the chip shortage that most of these companies, everything from a Maruti to Tata Motors, has highlighted. Who do you think stands to benefit from the entire EV play? Or would you say it's too soon to judge Indian companies with the EV canvas?
Yeah, I would say we are watching the companies closely, that look which companies have a clear transition strategies to EVs. I think Last 6 months, companies are also coming out and confidently talking about the migration strategies towards EV. There are some select plays in auto anchors. We've had some new listings in auto anchors companies which have exposure to EVs and are ramping up that exposure. So I think may not be a bad idea to play through auto ancillaries here, and then within EVs see which one of them, whether it's in tractors, utilities, or cars, which has a good kind of a part to migrate towards EV. But
Interesting. Okay, just going to take stock of what else is happening in the market right now. There's a Bata which is standing up, there's Concord which is holding out, there's Torrent which is looking good, PI Industries are also some names which are looking good as well. The other part of the market which got extremely excited, Rahul, about 3 odd months back with the entire PSU pack. You know, the government revived its privatization disinvestment drive once again, and you saw these stocks jump up. But wanted to understand how meaningfully, considering traditionally most most market participants have completely stayed away from any public sector undertaking. Just wanted to understand whether or not you have conviction on whether or not this privatization process is finally going to go through this time around or not, and whether you would be an investor in any of these companies here.
So I think we've seen sound bites from the government on this privatization. They've clearly laid out the intent loud and clear that they want to privatize all these non-strategic assets. But look, the privatization is taking longer than expected. So from our side, we would look at businesses on their pure merit, companies which are deepening their moat, enhancing their competitiveness, good, strong management. One would buy those businesses, and you've got your margin of safety. One would buy those businesses. Privatization is an added kind of I would say, cherry on top of this, but one would not buy names for privatization. We've seen HPCL, one was BPCL, sorry, one was looking for divestments to happen early last year. It's nearly 18 months since then, and we've not seen any progress over there. So I think purely buying for privatization may not be the best strategy. The idea here is you buy a business on a fundamental basis, and then if you get privatization, that's an added 20-30% kicker on.
Well, Rahul, we leave it at that. Thank you so much for sharing with us your insights from, for the entire market construct, from the consumption-oriented names to, of course, what we are seeing in terms of the more newer companies, the Zomato, Swiggies, and then finally PSUs and the cap good names as well.